Hello students, welcome to EPG Pathshala. I am Dr. Manjeet Singh from University School of Applied Management, Punjabi University, Patiala. Today, we are going to discuss about a module, Overview and Role of Stock Exchanges under the paper Business Environment. At the end of this presentation, you should be able to understand the meaning of stock exchanges. You should also be in a position to understand the overview of stock exchanges in India. Thirdly, we shall be discussing about the regulation of stock exchanges in India. And lastly, you will be in a position to know the role of stock exchanges in India. Now, what is a stock exchange? Stock exchange is an organized marketplace where the securities are bought and sold freely by the investors. These are the entities where the stocks and other securities are listed and traded. The stock exchange may be either a mutual organization or a corporation which brings its members together to participate in buying and selling of shares and other securities. These members of the exchange can either trade on the behalf of their clients or they can have their own account. Stock exchange facilitates the trade of securities that those which already exist in the market. So, stock exchange can also be called as a secondary market for the securities. And the existence of stock exchange provides the investors a ready market for their holdings or their investments in the form of securities. These members of the exchange can either trade on the behalf of their clients or they can have their own account for trading purposes. Stock exchange provides a platform for trading of securities that already exist in the markets. So, stock exchange is also known as a secondary market for the securities. The existence of stock exchange provides investors a ready market for their holdings. Meaning of stock exchange. According to Section 2, subsection J of the Securities Contract Regulation Act 1956, the term stock exchange means any body of individuals, whether incorporated or not, constituted before corporatization and demutualization under sections 4A and 4B, or a body corporate incorporated under the Companies Act 1956, subsection 1 of 1956, whether under a scheme of corporatization and demutualization or otherwise for the purpose of assisting, regulating, or controlling the business of buying, selling, or dealing in securities. Meaning of corporatization. According to Section 2, subsection AA of Security Contract Regulation Act 1956, the term corporatization means the succession of a recognized stock exchange being a body of individuals or a society registered under the Society Registration Act 1860 by another exchange being a company incorporated for the purpose of assisting, regulating, or controlling the business of buying, selling, or dealing in securities carried on by such individuals or society. Meaning of demutualization. According to Section 2, subsection AB of Securities Contract Regulation Act 1956, the term demutualization means the segregation of ownership and management from the trading rights of the members of a recognized stock exchange in accordance with a scheme approved by Security and Exchange Board of India. So, after studying these definitions and the terminologies, they clearly specify that earlier the stock exchanges in India could be formed as mutual organization. That is, an organization where the management rights and the trading rights as broker are bundled with the ownership of the share of the exchange. But such a structure of exchange invited a lot of criticism due to the number of drawbacks like lack of transparency, lack of professionalism in the management, lack of strict vigilance on the market, and the consequent manipulation of the markets by the brokers for their personal interests. The happening of two major scams, Harshad Mehta scam in 1992 and Ketan Parekh scam in 2001, also highlighted the significance of demutualization of stock exchanges. Moreover, such a structure of exchanges was also facing cash crunch for their technologically less upgradation and modernization, as they could not raise money by issue of equity shares to the others. In view of these shortcomings of these mutual stock exchanges, the Security Contract Regulation Act was amended in 2004 to corporatize and demutualize the stock exchanges in India. Demutualization is the process of converting the stock exchanges from the member-oriented stock exchange, non-profit-oriented stock exchange to for-profit, investor-oriented corporations. Corporatization is the process of converting the organization structure of the exchange from non-corporate to corporate. Section 4A of Security Contract Regulation Act 1956 ensures that all recognized stock exchange shall be demutualized and corporatized as per the procedure mentioned in Section 4B of the Act within the specified time. The process of demutualization and corporatization ensured that the ownership, management, and the trading rights are in different hands like a commercial entity. So it enabled the stock exchanges to raise the much needed funds to fight global competition and to attain growth. The happening of two major scams, that is the Harshad Mehta scam in 1992 and Ketan Parekh scam in 2001, also highlighted the significance of demutualization of the stock exchanges. Moreover, such a structure of exchanges was also facing cash crunch for their technological upgradation and modernization, as they could not raise money by issue of equity shares to others. In view of these shortcomings of the mutual stock exchanges, Security Contract and Regulation Act was amended in 2004 to corporatize and demutualize the stock exchanges in India. Demutualization is the process of converting the exchanges from member-oriented non-profit organizations to for-profit investor-oriented corporations. Corporatization is the process of converting the organization structure of the exchange from non-corporate to corporate. Section 4A of the Security Contract Regulation Act 1956 ensures that all recognized stock exchanges shall be demutualized and corporatized as per the procedure mentioned in the Section 4B of the Act within the specified time. The process of demutualization and corporatization ensured that the ownership, management, and the trading rights are in different hands, just like a commercial entity. It enabled the stock exchanges to raise much needed funds to fight global competition and to attain growth. Introduction. Today, there exists a variety of securities that are allowed to trade on stock exchanges. Section 2, subsection H of Security Contract Regulation Act 1956 states that the term securities includes the shares, scrips, stocks, bonds, debentures, debenture stock, or other marketable securities of a like nature in or of any incorporated company or other body corporate. It also includes a derivative or a unit or any other instrument issued by any collective investment scheme to the investors in such schemes. It also includes security receipts as defined in clause ZG of section 2 of the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. And it also includes the units of or any other such instrument issued to the investor under any mutual fund scheme. It also includes government securities, and it also includes any such instrument as may be declared by the central government to be securities. And lastly, it also includes the rights or interests in securities. Stock exchanges in India. Primarily, India has two stock exchanges, Bombay Stock Exchange and National Stock Exchange. But apart from these two main stock exchanges, we also have Metropolitan Stock Exchange and many other regional stock exchanges. Bombay Stock Exchange. Bombay Stock Exchange was formally organized in the year 1875. It was earlier known as Native Share and Stockbroker Association. It is the oldest stock exchange in Asia. It is the first exchange to be recognized under Securities Contract Regulation Act in 1956. In 1986, Bombay Stock Exchange developed BSE Sensex, which is called as Sensex, which is an index of 30 companies and which has taken base year of 1978-79, which is equated to 100. This Sensex basically attempts to measure the overall performance of the exchange. In 1992, the Government of India established Securities and Exchange Board of India under the SEBI Act to protect, develop and regulate the securities market. In 1995, the Bombay Stock Exchange introduced its online trading platform called Bolt. On June 9, 2000, the equity derivatives got introduced in the Bombay Stock Exchange, followed by the launch of index options on 1st of June 2001. Stock options were started on 9th of July 2001, stock futures on 1st of November 2001, currency derivatives and the interest rate derivatives on 28th of November 2013. Bombay Stock Exchange was corporatized and demutualized on 8th of August 2005 under the SEBI announced BSE Corporatization and Demutualization Scheme 2005. The shareholders list of Bombay Stock Exchange includes two leading global stock exchanges, namely Deutsche Börse and Singapore Exchange as its strategic partners. Bombay Stock Exchange provides an efficient and transparent mechanism for trading in the equity and debt instruments, derivative contracts, mutual funds, etc. Bombay Stock Exchange is world number one exchange in terms of listed securities. As on 26th Feb 2016, a total of 5,787 entities are listed on Bombay Stock Exchange, and the total market capitalization of BSE listed companies amounted to 86,34,614 crores. BSE also provides other services like risk management, clearing and settlement, market data, and education to the capital market participants. Trades done on BSE are cleared and settled through Indian Clearing Corporation Limited, a wholly owned subsidiary of BSE. The exchange provides depository services through its depository arm called Central Depository Services Limited, that is CDSL. National Stock Exchange. National Stock Exchange of India Limited was set up as a first electronically traded stock exchange in India. From the day one, National Stock Exchange got the form of a demutualized stock exchange. That is, its ownership, management, and trading rights were in the different hands with a different set of people. Its ownership is in the hands of leading financial institutions, insurance companies, banks, etc. Its management is in the hands of professionals who do not trade on the exchange and who are more qualified to manage the stock exchanges. National Stock Exchange got incorporated as a tax-paying company in November 1992. In October 1995, the National Stock Exchange became the largest stock exchange of the nation in terms of trading. The three important segments of National Stock Exchange trading platform got established one after other. The wholesale debt market segment, the NSE went live in June 1994, and the capital market equity segment in November 1994. Finally, the futures and options segment of National Stock Exchange of India started its operation in the index futures in June 2000, followed by index options trading in June 2001, stock option trading in July 2001, and stock future trading in November 2001. National Stock Exchange. The derivative segment of NSE expanded its operations further with the launch of currency derivatives on 29th of August 2008 and interest rate futures on 30th of August 2009. Today, NSE operates a nationwide electronic market offering trading in capital market segment, including equity, mutual funds, and exchange traded funds, derivative market segment, including equity, currency, and interest rate derivatives, debt market segment, including wholesale debt market, retail debt market, and corporate bonds. Trades done on NSE are cleared and settled through National Securities Clearing Corporation Limited, NSCCL, a wholly owned subsidiary of NSE. The prominent index of NSE, that is Nifty 50, was launched in April 1996. It is a well-diversified index comprising companies from 30 different sectors of the economies, and 50 companies are included in this index. The index represents nearly 66.17% of the free float market capitalization of the companies listed on the exchange as on March 2015. National Stock Exchange is the market leader today with the average daily turnover in the capital market segment of rupees 17,604 crores based on January 2016 figures. The average daily turnover in the equity futures and options is to the extent of 2,28,833 crores based on 2014-15 figures. Metropolitan Stock Exchange. It is formerly known as MCX Stock Exchange Limited. It is recognized by SEBI under Section 4 of the Securities Contract Regulation Act 1956. It is notified as Recognized Stock Exchange by Government of India on December 21st, 2012. It is promoted by major public sector banks, private sector banks, and financial institutions, and has an independent professional management. MSCI, as it is often called, offers trading in the capital market, futures and options, currency derivatives, and the debt market. MSCI commenced operations in the currency derivatives on 7th October 2008, capital market segment and future and options segment on February 11th, 2013, followed by trading in debt segment from June 10th, 2013 and cash settled interest rate futures on 10-year Government of India security from January 20th, 2014. Trades done on MSCI are cleared and settled through MCX SX Clearing Corporation Limited. SX 40 is the flagship index of the exchange with a base value of 10,000 and a base date of March 31st, 2010. The exchange has meager trading volume in its various segments. Besides these two prominent stock exchanges, there are many other stock exchanges operating in India. There exists over-the-counter Exchange of India, then Interconnected Stock Exchange of India, and some regional stock exchanges like Calcutta Stock Exchange, Delhi Stock Exchange, Ahmedabad Stock Exchange, and few others. However, all these stock exchanges are facing great difficulties in surviving. As per the new norms introduced by SEBI, every stock exchange should have a minimum net worth of 100 crores at all the times. And most of these stock exchanges, they are finding it difficult to meet this target. Further, the SEBI norms provide that the stock exchange can apply for voluntary surrender of recognition and exit if it reports an annual turnover of less than 1,000 crores on its platform. Also, a bourse which fails to achieve a required annual turnover of rupees 1,000 crore would be subject to compulsory exit. As a result of this, Hyderabad Stock Exchange and Enterprise Limited, earlier known as Hyderabad Stock Exchange, Coimbatore Stock Exchange Limited, Saurashtra Kutch Stock Exchange Limited, Mangalore Stock Exchange, Interconnect Stock Exchange of India Limited, Cochin Stock Exchange Limited, Bangalore Stock Exchange Limited, Ludhiana Stock Exchange Limited, Guwahati Stock Exchange Limited, Bhubaneswar Stock Exchange Limited, Jaipur Stock Exchange Limited, OTC Exchange of India, Pune Stock Exchange Limited, Madras Stock Exchange Limited, UP Stock Exchange Limited, Madhya Pradesh Stock Exchange Limited, and Vadodara Stock Exchange Limited were allowed by SEBI to exit the capital market space. Regulation of stock exchanges. Stock exchanges in India are regulated by the provisions of SEBI, that is Securities and Exchange Board of India. Secondly, the Security Contract Regulation Act 1956 also guides the stock exchanges, the bylaws of the exchange, and fourthly, the Ministry of Finance through the Department of Economic Affairs, that is Capital Market Division, also regulates the stock exchanges. The division of Department of Economic Affairs is responsible for formulating policies related to the orderly growth and development of security market as well as protecting the interests of the investors. The division of this Ministry of Finance also administers the rules and regulations made under the Depository Act 1996, Security Contract Regulation Act 1956, and SEBI Act 1992. Now, when we discuss about the regulation of stock exchanges, SEBI is one of the main regulator of stock exchanges in India. It was established in April 12, 1992 under the SEBI Act 1992. The primary objective of SEBI is to protect the interests of the investors and to promote and develop the securities market in India. All financial intermediaries, whether domestic or foreign, who participates in the Indian securities market are governed by SEBI regulations. Under the provisions of the SEBI Act, it is the duty of the SEBI board to adopt appropriate measures for the protection of investors' interest and for the promotion and development of securities market in India. Now let us discuss the role of stock exchanges. Stock exchanges play a very important role in improving the financial health of the economy. If we list down few of the benefits which we get, the prominent role which is played by the stock exchanges, the first one is that it acts as a barometer of the economy. Secondly, it provides ready market for the various securities held by the investors. Stock exchanges also effectively mobilize the savings. They facilitate capital formation and they also facilitate the optimum resource allocation. And that also offers, the stock exchanges also facilitate the offerings with regard to the wide investment avenues, and they also facilitate the risk management. They also help certain types of investors for the speculation activities, and it also facilitates the price discovery, and the stock exchanges also ensure the safety to the investors. And another important role which is assigned to the stock exchanges is to promote investors' education. The first important role played by the stock exchanges is that it acts as a barometer of the economy. Stock exchanges are considered to be the barometer of the nation, of the economy of the nation. It is one of the important leading indicators of the country's economy. Movements in the stock exchanges indices represent the aggregate response of all the investors towards the future expected state of different industries, sectors, or the overall economy. A rise in the stock market generally indicates better future growth in the country's economy and vice versa. Stock exchanges provides investors an opportunity to sell their securities on real-time basis at the best quoted price and without involving much effort. So, the stock exchanges provide a ready market to the investors to sell their investments. Stock exchanges help in effective mobilization of savings. Stock exchanges facilitate the trading of securities that are listed on the stock exchange and thereby provides liquidity to the various types of investments of individuals. It is primarily the availability of liquidity feature that encourages millions of the investors, whether individuals or institutions, to park their surplus funds in the needy companies through the route of initial public offering, that is IPO, or FPO, that is follow on public offer. In this way, stock exchanges help in channelizing the idle funds of the investors into the deficit corporate units to meet their productive requirements. Stock exchanges play a very important role in the capital formation because stock exchange is a platform which helps the corporate sector to raise the funds from those investors who have surplus funds with them. So, getting funds or channelizing the savings of the potential investor to the corporate sector which is in the need of the funds, that results into the capital formation in the nation. Optimum resource allocation. Stock exchange constantly does the evaluation of whole corporate sector of the nation and keeps on distinguishing between leaders and the laggards. This evaluation process of the stock exchange ensures that the surplus funds of the nation are parked into the most promising ventures, thereby assures the optimal utilization of the scarce resources of the nation. Now, another important role played by the stock exchanges is in terms of offering wide investment avenues. Stock exchanges provide ample investment opportunities to the investors with the surplus funds. Companies from diverse sectors issue various kinds of securities in the markets to meet the varied requirements of the investors. And the various kinds of instruments are made available on the exchanges to suit the varying objectives of the different class of investors. Risk management. The availability of derivative instruments on the various underlying assets provides investors and companies an efficient mode of risk management. The future and option contracts available on the equity shares and the equity indices enable the investors in Indian equity market to manage their investment risks. The availability of currency futures and option contracts enable the importers, exporters, and other companies expecting a foreign currency inflow or outflow to manage their exchange rate risk. Further, the interest rate derivative market enables the companies to hedge their interest rate risk. Speculation. Speculation aids liquidity to the market. So, its existence is must for the effective and efficient working of the stock exchanges. The derivative segment of stock exchange provides an opportunity to the investors to take a long or short position in a contract only by the payment of the margin money. Such speculative trades boost liquidity on the bourses, which could not otherwise be provided by the delivery-based trades. Moreover, the capital market segment of the exchange also provides speculative traders an opportunity to settle their trades on the same day without paying for the full amount of trade, thereby boosts liquidity on the stock exchange. Price discovery. Stock exchange helps companies in determining the fair worth of their shares. A company coming with an IPO can look at the prevailing price of already listed similar companies on the exchange to determine their issue price. Further, a company planning to come with a FPO can look at the price of its existing shares in the market to decide the appropriate price of its FPO. Another important role played by the stock exchanges is to ensure the safety to the investors' funds. Stock exchanges are regulated by their bylaws, the Security Contract Regulation Act 1956 and regulations of Securities and Exchange Board of India. These regulations keep a constant check on the manipulation, the price rigging, and other fraudulent practices on the stock exchanges which may cause unfair loss to the investors. Moreover, these stock exchanges also maintain an investors protection fund to protect the interests of the clients of those trading members which have defaulted or has been expelled under the provisions of any rules, bylaws, or regulations of the stock exchange. Investor education. The stock exchange also performs the function of educating the investors to widen the share ownership base, especially in developing countries like India. The stock exchanges run several investor education programs that help the investors in understanding the features of different types of securities and investments. So students, let us summarize what we have learned from this particular module. Firstly, we have talked about what a stock exchange means. If we go by its legal definition, there has been a lot of changes which have taken place in the definition of a stock exchange. So we have looked upon the legal perspective associated with the meaning of a stock exchange. Then we have also talked about the overview of stock exchanges in India. Primarily, we have two stock exchanges, Bombay Stock Exchange and National Stock Exchange. But apart from that, there are many other types of stock exchanges, but they are not playing a very active role as far as the objectives of stock exchanges are concerned. Thirdly, we discussed about the various regulators who regulate the stock exchanges, which comprises of the bylaws of the stock exchanges itself, then the important regulator SEBI, which is primarily established to regulate the stock exchanges in India. And apart from that, we have the Ministry of Finance, which also plays an active role in regulation of the stock exchanges. And lastly, we have also discussed about the very important types of role which is played by the stock exchanges in India. Thank you.